Sometimes the smartest people in the market don't make a sound. They just place a bet. And we found a huge one, a multi-million-dollar wager made by some very smart money on one of the oldest companies in America. So today, we're going to crack this thing wide open and see what they know that we might be missing.
And that's really the big question, isn't it? In a world that is just completely obsessed with AI, with software, with all things tech, someone with incredibly deep pockets is making a massive, really sophisticated bet on Union Pacific. I mean, we're talking about a company that's been moving stuff on steel tracks since the Civil War. So why? What's the real play here?
Okay, here's the evidence right here. This is not your average buy and hope for the best kind of trade. No. This is a complex option structure, a wager costing well over $500,000. It's really a two-part bet. One side makes a killing if the stock soars, but the other side actually sets a bargain price where they'd be thrilled to buy the stock if it drops. This is the work of a total pro. So to solve this mystery, the first thing we have to do is understand the tool this trader, this whale, is using. And it's a brilliant little strategy called a risk reversal.
A risk reversal is basically a way to make a huge bullish bet for a fraction of the usual cost. Here's how it works. You buy a call option. That's your bet that the stock is going to go to the moon. But to help pay for that bet, you sell a put option. And selling that put is kind of like telling the market, hey, if the stock drops to my bargain price, I will happily buy it from you. It's a really clever setup.
All right, so the first part of this trade is just pure optimism. The whale is betting that by April of 2026, Union Pacific stock is going to blast right past $265 a share. And trust me, that date is not an accident. It's timed perfectly to capture some crucial earnings reports and other big company news. And here's the safety net. By selling those puts, the trader collects money right away. That's instant cash in their pocket. And they basically set a standing buy order at $220. So they're telling us two things at once. One, they think the stock's going way up. But two, if they're wrong and it drops, they see $220 as a fantastic price to own a piece of this railroad giant.
Okay, so we get how the bet was made. Now we get to the really interesting part. Why? And all the clues seem to point to a new industrial playbook, one that's being fueled by huge global shifts and just incredible internal efficiency.
For decades, the whole story was globalization, right? Make it in China, ship it all over the world. Well, that story is changing. Companies are actively pulling their manufacturing out of Asia and moving it closer to home. It's a trend called nearshoring. And the new industrial heartland, it's becoming North America, especially Mexico. And guess what? Union Pacific's rail lines are the arteries that connect all of it.
And the engine that's powering all this movement is a surprisingly strong U.S. economy. I mean, despite all the fears of a recession, recent growth has been absolutely blistering. For a railroad, that is everything. A growing economy means more stuff, more materials, more cars, just more of everything that needs to get shipped on their tracks. It's that simple.
But it's not just about the wider economy. Internally, Union Pacific is running an absolute masterclass in efficiency. It's a philosophy called Precision Scheduled Railroading, or PSR. The goal isn't just to run more trains, it's to run them smarter. We're talking moving faster, less time sitting around doing nothing, and just squeezing every single ounce of capacity out of their network. And this number right here, this shows you just how well that strategy is paying off. This is their operating ratio, and it's the key metric for a railroad's profitability. Just think of it like this. It's how many cents it costs them to earn a dollar. So lower is always better. For Union Pacific to get this number under 60% is a record-breaking achievement. They are literally turning efficiency into pure profit. Now, beyond these big, sweeping trends, are whales also betting on two specific, game-changing events that could act like absolute rocket fuel for the stock?
The first one is Mexico. Union Pacific is the only railroad that serves all 6 major border crossings. That's a huge deal. And their Falcon Premium service, that's the crown jewel. It's this high-speed trade superhighway that moves goods from Mexican factories straight to the American heartland so fast it can actually compete with trucks. And believe me, that is a massive, massive advantage.
The second catalyst is some high-stakes corporate drama. Union Pacific trying to merge with its eastern rival, Norfolk Southern. Now, their first attempt was rejected, which caused the stock to dip a bit. But they have until June 2026 to try again. This creates what traders love to call a binary event, a clear win or lose situation that can make a stock swing wildly.
So why does this merger matter so much? Well, because if it gets approved, it would create an absolute titan of the rails. We're talking about the first company in American history that can ship goods from the Pacific Ocean to the Atlantic Ocean seamlessly on a single line. It would be a monumental competitive advantage, a true coast-to-coast powerhouse.
So you start putting all these pieces together, the global shifts, the efficiency, these big catalysts, and it all leads to the smart money's verdict. And it reveals a really fascinating trend. In 2026, old-school industrial might is starting to look a whole lot more attractive than new-age tech.
I mean, just look at this comparison. It tells the whole story. On one side, you've got Union Pacific, heavy assets, almost a monopoly, and it's just churning out record profits and paying a nice dividend. On the other side, you've got Uber, very few assets, fierce competition, and it's pouring money into this speculative dream of robotaxis. The contrast couldn't be more stark.
And this is exactly what we're seeing across the broader market. People are calling it the Great Rotation. After a decade of chasing growth at absolutely any cost, investors are starting to look for safety, for tangible assets, and for predictable, kind of boring cash flow. And Union Pacific is basically the poster child for this new era.
Now, let's be clear, this bet is not a sure thing. There are definitely risks. A big change in trade policy with Mexico could really hurt shipping volumes. Labor disputes are always just around the corner. The regulators could just say no to the merger for good. And of course, a sharp economic downturn would be bad for business, no question.
But here's the thing. Our whale has seen all of these risks. They've analyzed them, they've quantified them, and they still placed their $500,000 bet anyway. The signal they're sending is crystal clear. They believe the potential reward here is so large that it makes taking on all those risks totally worth it.
So let's bring it all home. The mystery is solved. This wasn't some random bet in the dark. It was a calculated strike based on what looks like a perfect storm of factors. You've got a railroad perfectly positioned for the nearshoring trend, a company running more efficiently than ever before, two huge catalysts on the horizon, and a market that is finally starting to reward real assets over pure speculation. In the end, this huge bet on a 160-year-old railroad is really so much more than just a stock trade. It's a thesis. It's a bold declaration that an era of building things, moving things, and manufacturing real, tangible stuff is back. This whale is betting on a whole new industrial age for North America. And the only question left is, are they right?